In this week's video, we'll cover 5 important stock market tells. We'll also be providing clients with a performance update relative to the screens that we added to the model in May of this year. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Tell number 1, resilient markets. The market's action on Friday, September 15, 2017 does an excellent job summarizing the concept of resiliency. Less than 24 hours ago, North Korea shot another missile over Japan. Financial markets have been dealing with ongoing political friction in Washington, D.C. Investors woke up on Friday, September 15th to the news that there was an explosion in one of the tubes in London. And despite a long list of things to be worried about, the markets continue to climb. Tell number 2, the economy. These headlines speak for themselves. Washington Post, September 12, 2017. U.S. middle-class incomes reach highest ever level in 2016. USA Today article dated September 14, 2017. U.S. job openings are at a record high. Stock market tell number 3, long-term breakouts. As we noted on Twitter this week, the recent headlines relative to a strong U.S. economy dovetail nicely with a video from early May with the title, "Are Stocks in the Early Stages of a Life-Changing Rally?" And you may remember in that video we covered a May 1st, 2017 MarketWatch article with the title, "A Life-Changing Rally is Shaping Up in the Stock Market, Predicts One Fund Manager." And this chart is just one example of many multiple-year long-term breakouts that we've covered over the past year. This chart here shows the NASDAQ in calendar year 2000. This is a breakout that occurred in July of 2016, telling us that the NASDAQ basically went nowhere, point to point, for 17 years. And we're all familiar with the expression, the longer a market goes sideways, the bigger the move that we can expect to get when we get either a bullish breakout or bearish breakdown. And we are all also familiar with the concept that the longer the breakout holds, the more meaningful it becomes. As of Friday, September 15th, 2017, the long-term breakout in the NASDAQ is holding nicely. Stock market tell number 4, ongoing skepticism. Markets are often said to climb a wall of worry, and there's plenty of worry in the financial markets in 2017. One hot topic is valuations that we've covered in the past. As we noted in a January 2017 video, PE ratios appeared to be elevated early in this calendar year. However, PE ratios also appeared to be elevated in the early 1990s, in the mid-1990s, near a stock market peak, near a major bottom, near a stock market peak, and near a major bottom, reminding us that despite what appear to be elevated PE ratios, history tells us that earnings growth coupled with multiple expansion can push markets higher. If we said high PE ratios were a reason to exit the stock market, we could have said the same thing at this point here. And after this point here, the market rallied for years, with the S&P tacking on an additional 232%. If we said high PE ratios were a reason to look the other way when the market bottomed here, from this point here, we would have missed a 41% additional gain that took place over several years. As we've noted numerous times, valuations are a poor timing tool. Stock market tell number 5, trends. You may remember from last week's video, we said that the trend strength model, which is a sub-model of the master market model, looks at trend strength using multiple inputs and multiple time frames. And as of last Friday, a week ago on September 8th, 100% of the binary bullish or bearish questions that were asked were being returned with a bullish answer. Since then, as of 2:27 p.m. Eastern Time on Friday, September 15th, a week later, the S&P 500 was up 36 points over the past 5 sessions. Common sense tells us if we're up 36 points over the past 5 sessions and we had a score of 100% a week ago, most likely we did not see any significant deterioration in trends over the past 5 days. If we fast forward to the present day, the facts align with common sense. Intraday on Friday, Kathy updated the trend strength model, and once again, it is returning a score of 100, telling us based on the facts that we have in hand right now, we are still allocated properly. And as we did a week ago, we will head into next week with an open and flexible mind, and we will continue to look at the data. If you prefer a visual, and we could choose numerous time frames and numerous charts and they would paint a similar picture, this is the tell that we want to avoid. These are the same moving averages on Friday, September 15th, 2017. As clients and regular viewers know, we're in the process of backtesting the screens that we added to the master market model back in May of this year. And this is a slide from a May 2017 video where we talked about some of the recent frustration with our positions from January 1st to late May of 2017, and the screens, a simple and powerful adjustment that we added at that time. You can go back and watch every single weekly video since the US election, and every one of them has been bullish, meaning the master market model is working very, very well. We demonstrated in May that our ETF selection process is working fine. Our implementation and discipline, we're getting an A+. We added those screens and noted back then, in some ways, we were actually simplifying the model by putting some screens before data entered the master model. We are happy to report, since adding the screens and flipping some positions out of our portfolio based on those screens, the new front-end screens have been adding value. If we look backwards 60 calendar days from September 14th back to June 14th, in that May 2017 video about the third week of May, we highlighted numerous ETFs, including large cap growth and tech. Using those screens, we added both of these positions to our portfolios, and the results have been excellent. Technology has significantly outperformed the S&P 500 over the past 2 months, and large cap growth stocks have significantly outperformed the S&P 500 over the same period, telling us that the simple and powerful adjustment should be alleviating our frustration as time goes on. 2 other pieces of good news: we're making excellent progress on the back testing of those new screens. It's going to be a very, very time-consuming project, but one that is well worth it. And every single one of our core positions over the past 5 sessions was profitable, which reinforces the idea that the screens are adding value. As we've demonstrated with the trend strength score, as of Friday, September 15, 2017, the data that we have in front of us looks good from a risk-reward perspective, but we also know that we must maintain that flexible, unbiased, and open mind, because it's only a matter of time before the next crisis or bear market rears its ugly head. Typically, the longer a bull market goes on, the more in vogue buy and hold becomes. And just when buy and hold becomes completely entrenched on Wall Street, the inevitable bear market arrives, and near the end of the bear market, we'll be reading articles that say buy and hold is dead. We've made some improvements to the bullish side of the model. We just went through a live bear market fire drill in February of 2016. That portion of the model is working fine, which will be important because, as happened after the dot-com bubble burst, 3 years of gains can be wiped out very, very quickly, or in the case of the financial crisis, 11 years of buy and hold gains were wiped out in a very, very short period of time. We should also keep in mind that the model is looking to produce returns over a full market cycle. Why is that important? Let's assume that we had two portfolios, each investing $500,000. Strategy A returned 22%, 33%, 28%, and 21%. Strategy B that managed risk returned 12%, 13%, 11%, and 10%, looking like a relative dog when compared to Strategy A. With Strategy A, 500,000 would have turned into 1.2 million. Strategy B would appear at this point to be disappointing, turning 500,000 into 772,000. However, Strategy A does not have any game plan for the next inevitable bear market, and Strategy B manages risk based on the facts in hand. We were actually looking at S&P 500 returns here with Strategy A between 1996 and 1999. Unfortunately, after everybody said buy and hold is the way to go, the S&P 500 posted back-to-back-to-back returns of a negative 9%, negative 11%, and negative 22%. If the more conservative Strategy B was able to migrate to defensive bonds and post returns of 8, 7, and 6, this looks relatively boring relative to this here. However, over the full market cycle, Strategy B wins. The $500,000 is worth $946,000. In this case, the $500,000 grows 1.2 million, but unfortunately buy and hold sees it return to less than Strategy B at under 800,000. This strategy is thinking about both bull and bear markets. This strategy does very, very well in bull markets. Similar situation with the financial crisis. S&P 500 returns here appear to be blowing away this investor here. But when the next inevitable bear market / crisis arrived, the 914,000 buy and hold portfolio dropped to 575,000, and the more conservative were thinking about the miracle of compounding was worth more at that point at 703,000. The miracle of compounding works both ways. It can work for us and it can work against us. The last two bear markets destroyed wealth rapidly. A 51% drop here and a 58% drop here in the S&P 500 index. So as we head into next week, it's always important to maintain that flexible, unbiased, and open mind so when the data starts to change, the facts in front of us, we can properly migrate from a growth-oriented portfolio to a more defensive portfolio. And thankfully, when we have the defensive game plan in hand before the next crisis, it brings peace of mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.